Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, I'm going to talk about whether we're going to have a great stock market rotation in the upcoming months. I think stock market rotation is a very important topic now because the current market as represented by the regular S&P 500 is largely driven by mega cap stocks, specifically the Magnificent 7 stocks. This is why the regular market cap weighted S&P 500 has outperformed the equally weighted S&P 500 by a lot over the past 1 year. The S&P 500 has outperformed the equally weighted S&P 500 over the past 3 years, and the regular S&P 500 has outperformed the equally weighted S&P 500 over the past 5 years. All these comparisons show that the S&P 500's total return is largely dependent on the largest mega cap companies. I want to show you this meme here. It shows the current market sentiment. More importantly, this meme shows that the current bull market is largely driven by the Magnificent 7 stocks and not driven by the other 493 stocks yet. Here's the deal. During this bull market, if your portfolio is heavily concentrated on the Magnificent 7 stocks, it will be performing exceptionally well compared to the rest of the market. However, if your portfolio is concentrated on other stocks outside of the Magnificent 7 stocks, it will likely underperform the market by a large margin. And worse, if you have invested in many small caps in your portfolio, you're likely still losing a lot of money. Of course, your portfolio is likely underperforming the S&P 500 and Nasdaq 100 by a significant margin. At the time of making this video, many investors are looking to invest outside of the Magnificent 7 stocks because they believe that they can find much better values in small caps and other stocks. Also, most other stocks outside of the Magnificent 7 stocks have not rallied much this year. So in this video, I'm going to talk about these topics. Will we have a great market rotation in the upcoming months? Will small caps finally outperform the S&P 500? And what's my investing strategy going forward? If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis and investing videos every week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you will know when the stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. So will we have a great market rotation in the upcoming months? Will the current bull market broaden to other stocks? This is my prediction. I believe the market will continue to broaden beyond the Magnificent 7 stocks because many of the 493 stocks in the S&P 500 are expected to report higher earnings growth in the upcoming quarters. Typically, the best and largest tech companies tend to recover much faster during the early bull market. However, once interest rates start to decrease and the other 493 companies start reporting higher earnings growth, we can expect that their stocks will also recover more. Here's another thing we should consider. At the time of making this video, the Magnificent 7 stocks as a group have increased significantly more compared to the rest of the S&P 500 stocks in recent months. Many investors are looking to reduce their investments in the Magnificent 7 stocks because they want to capture their gains or they believe that they can find better values in small caps and in the rest S&P 500 companies. They also believe small caps and the rest S&P 500 stocks can recover more going forward. This kind of stock market rotation happens quite often and is normal. This from Investopedia. The Magnificent 7 drove S&P 500 earnings growth in the last 3 quarters and accounted for more than half or 59.5% of the S&P 500's total return in the first half of the year, according to data from LPL Financial. Of course, the current bull market is heavily concentrated on the Magnificent 7 stocks, but for the bull market to continue, the other companies will need to recover. I think this is what many investors are expecting now. According to this article here, There are generally three stages of sector rotation. During the early bull market stage, financials, technology, and consumer discretionary businesses tend to recover much faster. These businesses tend to perform the best during this stage. After that, during the mid to late bull market stage, the bull market tends to broaden to other sectors. Materials, industrials, energy, and telecom businesses tend to perform well during this stage. Lastly, during the bear market stage, the more defensive industries such as healthcare, staples, and utilities tend to perform the best. These businesses are much less cyclical. They are much more recession-proof. If I have to make an educated guess, I think we're probably somewhere between the stage 1 and stage 2 cycles. As of now, the market is slowly broadening to other sectors and small caps. Of course, every bull market is different. Every market rotation is different. Going forward, many analysts and investors expect that the market will broaden more because many S&P 500 companies outside of the Magnificent Seven will start reporting better earnings in the upcoming months. According to FactSet, the S&P 500's EPS is expected to grow much more throughout Q2 2024 to Q3 2025. Also, the US inflation is already slowing down to the 2% inflation target. The US Fed is expected to start decreasing rates later this year, probably starting in September this year. When the Fed starts decreasing rates, it will benefit small caps the most because their cost of borrowing will be lower. Typically, small caps are very sensitive to interest rate change because they tend to have a lot of debt on their balance sheets. Small caps tend to perform the best when interest rates are low and when monetary policies are loosening because they can borrow debt much easier at lower rates. Since the Fed will start decreasing rates soon and many S&P 500 companies are expected to have higher earnings in the upcoming quarters, I believe we will likely have more market rotations going forward. In other words, the current bull market will likely broaden more going forward. But over the longer term, even if the market broadens more, I expect that the market cap weighted S&P 500 will continue to outperform the equally weighted S&P 500. Here's why. The largest companies tend to be much more profitable than the smaller companies. The largest companies tend to be the most competitive in their industries. For example, the Magnificent Seven stocks, Nvidia, Microsoft, Apple, Google, Amazon, Meta, and Tesla, are the market leaders in their industries. They have the largest economic moats. It's very hard for competitors to compete with them. They also earn the most profits and most free cash flows compared to competitors. So naturally, the largest mega cap companies as a group should outperform most other smaller companies in most years. This is why I believe the regular market cap weighted S&P 500 will continue outperforming the equally weighted S&P 500 over the long run, even if we will have more market rotations in the short term. So will small caps outperform the S&P 500 going forward? In other words, are we going to have a great stock market rotation soon? I'm going to be a contrarian here. You may not agree with me on this, but that's okay. I'm just sharing my perspective with you. In the short term, I think small caps will likely outperform the S&P 500 or even the Nasdaq 100 because the Fed is expected to start decreasing rates as soon as September this year. Also, many investors are rotating their investments from large caps to small caps, at least for the short term, because they believe that small caps are much more undervalued compared to large caps. Of course, small caps benefit the most when interest rates are lower because many small caps rely on a lot of debt to finance their growth. This is the great stock market rotation many investors are looking for. In the long term, I believe most small caps, as represented by the Russell 2000, will continue underperforming the S&P 500 and Nasdaq 100 by a very large margin. Let me explain here. There's a huge misconception about small cap stocks. In many finance and investing programs, they teach that small caps tend to outperform large caps over the long term. This is completely wrong. Small caps do not outperform large caps over the long term because their businesses are generally much weaker and not as profitable as large cap companies. For example, if you look at the list of small caps in the Russell 2000 and if you review their financials, you will notice that many of these small cap companies are not profitable yet. Many of them carry very large debts on their balance sheets. Many of them have negative operating income and negative free cash flows. Some of their operating income cannot even cover their interest expenses and debt payments. Also, many of these small caps are not very strong businesses. They do not have large economic moats and very strong financials like many mega cap tech companies. Here's the deal. Business performance always determines stock performance over the long term. In the short term, small caps will benefit the most from lower interest rates. The market already expects this. But in the long term, small caps, as represented by the Russell 2000, will need to report strong earnings growth in order to outperform the S&P 500 and Nasdaq 100. Otherwise, if small caps still don't have strong earnings growth after rates start to decrease, the great market rotation will just be temporary. Also, we're not going back to the very low interest rate environment and have very easy monetary policies like during the pandemic. This is why I believe small caps, as represented by the Russell 2000, will continue underperforming the S&P 500 and Nasdaq 100 over the long term. For example, over the past 1 year, you can see that the Russell 2000 ETF underperformed the S&P 500 and Nasdaq 100 ETF. Over the past 3 years, the Russell 2000 ETF underperformed the S&P 500 and Nasdaq 100 ETF by a very large margin. Over the past 5 years, the Russell 2000 ETF also underperformed the S&P 500 and Nasdaq 100 ETF by a very large margin. And over the past 10 years, you can see that the Russell 2000 ETF underperformed the S&P 500 and Nasdaq 100 ETF by an even bigger margin. Even though past performance does not guarantee future results, all these historical performances show that small caps tend to underperform the S&P 500 and Nasdaq 100 over the long term. And the biggest reason is that small caps, in general, are not very strong businesses. Most of them do not have strong fundamentals like large caps. Most small caps are not as profitable as the large caps in the S&P 500 and Nasdaq 100. Only very few small caps are great businesses. So what's my investing strategy going forward? Personally, I'm not investing in small caps, no matter how cheap they are compared to large caps. I like to keep investing in the best businesses that are most competitive in their industries. Many of them happen to be large caps. My investing strategy is to keep investing in the best businesses that have large economic moats, great products and services, great long-term business prospects, great management teams, increasing earnings, and increasing free cash flows over time. Then I like to buy them only when they're fairly valued or undervalued. This is to make sure I'm not overpaying them. This reduces portfolio risk by a lot. Once I buy them, I like to hold them for the long term, so their business values can grow exponentially over time. Also, I do sell some stocks occasionally if they become substantially overvalued. At the time of making this video, the market is greedy again. Going forward, I will likely sell more stocks when the market becomes extremely greedy again. I think it's important not to FOMO in this market. It's much better to be very greedy when the market is very fearful and to be very fearful when the market is very greedy. I'll give you several examples here. This is one of my stock portfolios. It's separated into 3 different accounts. In the first account, you can see that it's doing very well. I have invested in Microsoft, MasterCard, Visa, TSMC, Amazon, Google, ASML, American Express, and Meta. You can see that all of them are large caps. I don't invest in small caps. All these companies are the market leaders in their industries. They have the largest economic moats. They are also the most profitable in their industries. I bought them when they were much more undervalued before. This is why they have performed very well over the years. I expect they will continue to grow exponentially over time. This is the second account. This account is also performing very well compared to the S&P 500. I have invested in Apple, Google, Microsoft, TSMC, Visa, Nvidia, American Express, and Amazon. All of them are large caps. Again, I don't invest in small caps. I sleep much better investing in these outstanding businesses because I know they're the best businesses in their industries. All of them have very large economic moats and great long-term business prospects. They are essentially near monopolies. It's extremely hard for competitors to compete with them. I expect they will continue to perform very well over the long term. This is the third account. This account is much newer than the other 2 accounts, so it will take longer for these outstanding companies to become multi-bagger stocks. I have invested in Microsoft, TSMC, Nvidia, American Express, Google, MasterCard, Amazon, Synopsys, Tesla, Adobe, Meta, Visa, ServiceNow, MSCI Inc., Salesforce, and Broadcom. Recently, I've reduced my position in Tesla and sold more Tesla shares because I believe Tesla is overvalued now. Then I reinvested the money and bought more Nvidia and Broadcom shares because I believe Nvidia and Broadcom are much better businesses than Tesla. For example, if you review their financials, you will notice that Nvidia and Broadcom are much more profitable than Tesla. Their operating margins and free cash flow margins are much higher than Tesla. They are benefiting the most from the current AI revolution. They also don't need to lower their prices like Tesla in order to increase demand. There are very few competitors that can compete with Nvidia and Broadcom in their semiconductor businesses. On the other hand, Tesla has many competitors, especially the Chinese EV makers, that can mass produce EVs at very low costs. Before ending this video, I want to show you my intrinsic value spreadsheet here. I always update this intrinsic value spreadsheet for all my Patreon members every week. If you want this intrinsic value spreadsheet, you can download it from my Patreon blog. The link is in the video description. I always use this intrinsic value spreadsheet to keep track of all the best businesses I want to invest in. Before investing in any stocks, I always use this intrinsic value model to calculate the intrinsic value. For example, if I want to buy more Broadcom stocks, I will calculate the intrinsic value first. This is to make sure I'm not overpaying the stock. Then when the stock I like becomes fairly valued or undervalued, I will keep buying it over time whenever the stock dips below its intrinsic value. When the stock becomes overvalued, I may sell some shares if I can reinvest the capital in other outstanding businesses that are undervalued. This strategy has worked very well for me for many years. Now, all these are only my opinions and my analysis is based on my research. They are not financial advice. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.